Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, November 21st at 11 a.m. in New York. So let's get after it. Last week, we published our 2023 U.S. Equities Outlook. In it, we detail the path to our 2023 year-end S&P 500 price target of 3,900. While the price may seem unexciting relative to where we're currently trading, we think the path will be quite volatile, with several key inflection points investors will need to trade to make above-average returns next year. The main pushback and focus from investors has centered around the first inflection, the near-term tactical upside call we made about a month ago. Let's review a few key points to the call as we discuss how the rest of the year may play out. First, the primary technical driver to our bullish call was simply respecting the 200-week moving average. As noted when we made the call last month, the 200-week moving average does not give way for the S&P 500 until a recession is undeniable. In short, until it is clear we are going to have a full-blown labor cycle where the unemployment rate rises by at least 1 to 1.5%, the S&P 500 will give the benefit of the doubt to the soft landing outcome. A negative payroll release also does the trick. Second, in addition to the 200-week moving average as key support, falling interest rate volatility led to higher equity valuations that are driving this rally. Much like with the 200-week moving average, though, this factor can provide support for the higher PEs achieved over the past month, but is no longer arguing for further upside. In other words, both the 200-week moving average and the interest rate volatility factors have run their course in our view. However, a third factor, market breadth, has emerged as the best technical argument for higher prices before the fundamentals take over again. Market breadth has improved materially over the past month. As noted last week, both small caps and the equal-weighted S&P 500 have outperformed the market-weighted index significantly during this rally. In fact, the equal-weighted S&P 500 has been outperforming since last year, while the small caps have been outperforming since May. Importantly, such relative moves by the small caps and average stocks did not prevent the broader market from making a new low this fall. However, the improvement in breadth is a new development, and that indicator does argue for even higher prices in the broader market cap weighted S&P 500 before this rally is complete. Bottom line, tactically bullish calls are difficult to make, especially when they go against one's fundamental view that remains decidedly bearish. When we weigh the technical evidence, we remain positive for this rally to continue into year-end, even though the easy money has likely been made. From here, we expect more choppiness and misdirection with respect to what's leading. For example, from the October lows, it's been a cyclical small cap-led rally with the longer duration growth stocks lagging. If this rally is to have further legs, we think it will have to be led by the NASDAQ, which has been the laggard. In the end, investors should be prepared for volatility to remain both high intraday and day-to-day with swings in leadership. After all, it's still a bear market, and that means it's not going to get any easier before the fundamentals take over to complete this bear market next year. As we approach the holiday, I wanted to say a special thank you to our listeners. We've recently passed an exciting milestone of over 1 million downloads in a single month, and it's all made possible by you, tuning in and sharing the podcast with friends and colleagues. Happy Thanksgiving to you and your families.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.